Good afternoon, everybody. Today we're going to be looking at some more earnings, and we're going to be looking at Adobe stock, which just reported their Q1 earnings. This is a company that is another beaten down tech stock. It was at one point $665, and now it's at $332, so it's down 50% from the highs. So let's have a look at the earnings from a fundamental analysis and see if it's worth a buy. Looking at the earnings estimates for Adobe, we can see from an earnings per share perspective, they're expected to grow in the double digits for the foreseeable future up until 2025. And then from a revenue perspective, it's a little bit lower in the single digits for the upcoming quarters. And then again, it's expected to accelerate to the double digits, the low double digits. So it's still a pretty significant growth, the company this large growing this much. Of course, it's not as much as during the pandemic where they were growing at a much faster rate, but that was similar to a lot of tech companies. Having a look at the earnings surprise summary for this company, we can see that they usually beat their expectations consistently. So in the past couple of years and quarters, we've seen that it's always been a beat for the earnings per share. And in the previous quarters, it wasn't that big of a beat, especially in the 2021 where it was just like 0.04%, but they're consistently beating the expectations of the analysts. And when we look at the revenue surprise, the last two quarters, they actually didn't meet the expectations, but everywhere else, they were meeting the expectations, except for the May quarter during the pandemic. So they are a company that can be expected by analysts to always beat the expectations that they are putting forth. So that does give a lot of confidence for people who are invested in a company like this. Some news about Adobe. In September of last year, we found out that they want to buy a company called Figma for $20 billion. This company creates creative software similar to Adobe, but the shares went down more than 16% after this news. And it's really easy to see why this happened. Because Figma, they only have a revenue of $500 million in a year. So Adobe paid 50 times price to sales for this company. And this deal, half of it is going to be in cash and the other half in stock. As well as the employees are going to be receiving 6 million in additional Adobe shares. So this is all going to be dilution for the shareholder. So it's very easy to see why investors didn't like this deal. Shopify, which is a company that a lot of people think is expensive, has a price to sales of 9.45, but Adobe had paid basically 5 times that for this company. In February of this year, just a couple days ago, we found out that there's going to be a suit for this acquisition. So the US Department of Justice has announced that it is trying to block this $20 billion acquisition. And the shares went down 8% after this as well. So this is kind of a surprising move because you would think that investors would like that the Department of Justice blocks this deal because it's a very bad from an investment perspective. But the shares are going down from this. But you never know, even if the deal goes through, some acquisitions can be very good. And this company has done many acquisitions. So every couple years, they are doing acquisitions and they've been able to grow their company very well through these acquisitions. But if you see this Figma deal, it is definitely their biggest acquisition when you look at it from a size perspective. So let's see what happens. Instagram, when Facebook originally bought it, had also had very similar questions because they paid $1 billion, which is still a lot lower than what Adobe is paying for a money-losing company. And we all saw how big Instagram became afterwards. So you never know. When you look at the graphic design market, you can see that Adobe is the market leader. Their software, Adobe Illustrator, has 38% of the market. And when you look at the alternatives to this, almost everything else is Adobe as well. So in the top 5, we have Photoshop with 24% of the market, InDesign with 14.6% of the market, and the only alternative is Sketch, which has 12% of the market. So when you combine all of these products, Adobe basically has 85% of the market for graphic design software. So this is going to be a huge moat for this company, which should help in the future for increasing prices. It's not very good for consumers, but as investors, we do like to see big moats And Adobe definitely has a very big moat for the graphic design market. Another metric that I really like looking into is insider activity, because that really helps me find out when to buy and sell shares. We see that in the past 12 months, almost all the insider trading has been in sales, except for 2 buys. And in the past 3 months, everything has been sales. When we look at the sales, there hasn't been anything in the past month. And most of it has been in 2022, where there was a lot more fear in the market. So it does make sense where there would be more sales. But personally, for me, I really like buying companies where the insiders are also invested in the company and actively buying shares. And Adobe doesn't have any insider activity in the past 3 months. And personally, for me, that's kind of a red flag. But other people are going to have different opinions on this, because there's many different reasons where insiders can sell shares, where they need to raise some money. But when insiders buy shares, there's only one reason why an insider would buy shares, and that's because they think their company is going to go up in the future. And that gives you a lot more confidence to buy the company, because the insiders are putting their own money on the line. Now, getting into the actual earnings report, we can see that they have beaten their expectations. So from a top line, the non-GAAP earnings per share was 3.8, which beat the expectations by 12 cents. And then the revenue was also up 9.4%, which beat the expectations a lot lower, but by 40 million. And then when we look at the guidance, they've also provided that. They expect the total revenue to be between 4.75 and 4.78 billion, which when we look at the expectations, that's very similar, because analysts were expecting at the midpoint 4.76. When we look at the earnings per share, it's expected to be between 3.75 and 3.8, which is also within the expectations, where analysts were expecting 3.76. So overall, the quarter was a beat, and we can see that the shares have gone up because of this earnings. Now, getting into the earnings report, we can see that from an income statement, almost all the revenue for Adobe comes from subscription-based revenue. And this is very nice to see, because these are recurring sources of revenue that you can expect over time. And this is the best type of revenue that you can have in a company. And that's what's very appealing about a lot of these type of cloud companies. So the total revenue from previous year has gone up around $400 million, but the cost of revenue has only gone up 50 million, and they have very good gross margins. That's why their gross profit is at $4 billion, which is very nice to see on $4.6 billion worth of revenue. But when we look at the operating expenses, it has ticked up across the board. So now we have $400 million almost in extra operating expenses. So the operating income is basically flat year over year. And then when you add back in some interest expense and then other income, we can see that actually the net income has gone down from the previous year, where it's now at $1.2 billion, where last year it was $1.266 billion. But the earnings per share has gone up, and that's because they are doing buybacks. So when you look at the shares that were used to compute the diluted net income per share, there was 460 million shares this quarter, but in the previous year, there were 475 million. So that's good to see that they are doing share rebuybacks, but it's not very nice to see that the net income is basically flat. It hasn't really gone up that much, but a lot of tech companies are doing layoffs. So hopefully the operating expenses in this company will start going down over time. Now looking at the balance sheet, there's nothing to really worry about here. When we look at quarter over quarter, the total assets has gone down slightly. But when we look at the liabilities, it has also gone down around the same amount. And I don't really see much to worry about here. When you look at total assets to total liabilities, they have basically double in assets. So they'll still be able to do lots of buybacks and doing more acquisitions as well, because there's nothing to really worry about from a balance sheet perspective on this company. Now, having a look at the technical chart for Adobe, you can see that after the huge rise up to 680, the stock has gone down all the way to 284. But when you look at the 6-month chart, it has been trading in a much narrower range from 349 all the way to 320. There was a period where it did go up all the way to 400, but has since come back to this range. And we can see that after the earnings, the shares did go up 4.6%. So it got right to this top of the range at 349 right now. So is this company a buy from a technical analysis? I would say it isn't, because we've seen a lot with companies where they go up to the top of the channel and then after a couple of days they do go back and retest this $333 level. And personally for me, I'm not a buyer of the company at this moment. I really like looking at insider activity to decide when to buy and sell companies. And right now everything has been sales. So when we see some more confidence from the management of their own company and people start buying more shares, I would be more confident to buy shares of this company. So right now I am on the sidelines for this company, and that's basically my analysis of this company. If you like this video, like the video and subscribe for more videos in the future. Thank you.